Hi everyone, Jessica Long. Just wanted to chat a little bit about the Fed. We just had the Fed speak yesterday. I said they're not going to, Federal Reserve not going to raise rates, and so that always brings up a lot of talk about the Fed rate and mortgage rates, which aren't directly tied together. The Fed rate is what they set that for what the banks, the rate that banks are going to spend to borrow money overnight. So when the banks lend out money, they also need to be cash flow, so people come in and make withdrawals. They can lend more money. So if they come up short, they'll borrow money overnight, and the Fed determines that rate. So that rate obviously has an impact on all borrowing, right? Because the more the money costs for the bank, the more they're going to charge you to loan the money. But for mortgage rates, that's really tied more to credit cards, personal loans, those sorts of things. For mortgage rates, they're really tied to the 10-year Treasury and the bond market. So obviously, anytime the Fed makes a decision, it's going to have a ripple effect on the whole market. But is it directly tied to mortgages? No. So when you hear all this talk in the news about the Fed rate, don't get wrapped up that that's really directly tied to mortgage rates.